Should you use one mutual fund company or many? Hi, I'm Dave Grant. I'm a certified financial planner and the founder of Retirement Matters, a financial planning company based in Barrington, Illinois. Now, in the world of investing where there's more than 9,500 mutual funds, it's not at all uncommon to see investment portfolios with a potpourri of mutual funds from different fund companies. It's very common among investors who work with a brokerage firm where financial advisors have access to a wide range of fund families. If you're a do-it-yourself investor, you might add funds from different families based on their recent performance, or as a way to achieve greater diversification. But is that a wise strategy? What do you expect to accomplish by investing in funds from different fund families that you couldn't achieve with funds from one fund family? Here are some of the reasons why investors invest in multiple fund families and why they might want to reconsider. Fear of financial failure. One reason investors give for spreading their assets around different fund companies is to minimize their exposure to any one company in the event of financial failure. Now, it should be noted there has yet to be a financial failure or bankruptcy reported by a mutual fund company. It's not to mean it couldn't happen, but it is highly unlikely. So even if it did, investors' assets are protected because they're walled off from the company held in trust by a custodian, a separate legal entity. They're not the assets of the company and therefore not subject to creditor claims. So if a mutual fund company did fail, the assets are still accessible to customers through the custodian. The greater risk exposure for investors is market risk. So if it's diversification that you want, you should focus on diversifying by mutual fund type and not mutual fund companies. Fund companies such as Vanguard and Fidelity offer several hundred different types of mutual funds, which is enough to achieve optimum diversification for most investors. However, some investors might want to add exposure to a particular market sector or a niche that isn't covered by a fund family, so they purchase a mutual fund as a one-off from another family. For example, you might have a strong interest in companies that are environmentally responsible, so you'd seek out a mutual fund with a strong track record of investing in such companies. Generally, these types of funds aren't core holdings at these big brokerage houses, so you have to go find a company that does specialize in these things. Investing in winners. Now, investors who believe that actively managed funds are a way to enhance portfolio performance, either as a sole strategy or as one that's complementary, they'll sometimes cobble together a portfolio of funds that they believe have the best opportunity to outperform their benchmarks. Now, while it's very difficult to identify actively managed funds that consistently outperform their benchmarks, the strategy has a better opportunity of working when assets can be diversified among several different funds from different fund families. Although the strategy does have the potential to generate greater returns, it comes at a higher cost due to higher investment costs. Is it worth this extra cost? Perhaps the biggest reason to avoid the use of multiple fund families is the cost of investing, especially if you invest in funds that charge a sales load. Most of these funds offer breakpoints that reduce the sales load when an investment threshold is met. Some offer breakpoints that will reduce the charge to zero, but your investment may have to be as high as $100,000. Even no-load funds such as Vanguard offer funds with lower management fees for larger investments of $10,000 or more. If you're going to mix your fund families, it is important to be aware of the breakpoint thresholds to keep your investment costs at a minimum. In most cases, using a plethora of mutual fund families isn't necessary. The diversification that most investors need can be found by investing in one or two fund families. This then keeps the investment approach simple, it keeps the cost low, and it allows for time and energy to be spent on more fulfilling activities. So I'll leave you with this. If you think that you have a portfolio that is a little hodgepodge, doesn't have a cohesive design to it, why not get in touch and we can review it and actually see where it can be made better.